might surprise you. We do the highest percentage in Omaha, and what's interesting is that we I won't give you the exact numbers, but it's large. We do a significant with dollar volume, but a very significant portion of that volume people come to the store to pick up, so that they will order something from us online, but they don't mind. They don't seem to mind at all, and they don't have to do it, but they get a pickup at the store. So, you learn what customers like, just like people learned in fast food, that people would buy a lot of food by going through a drive-in, that they don't want to stop and go into the place. We learn about customer behavior as it unfolds, but we did do now, on Tuesday, we did 9.2 million or 9.3 million of profitable volume at the Nebraska Furniture Mart, and I think that company had paid in capital of $2,500, and I don't think anything's been added since. So it's working so far. The first quarter, it's interesting, the first quarter was weak at all four of our furniture operations. But there's certain other parts of the economy, just home building generally. It's considerably below what you would have expected, considering the recovery we have had from the 2008-9 period. I mean, if you look at single-family home construction, the model has shifted more to people living in apartment rentals. I think it's gone from 69 and a fraction percent. It got down to 63%. It's bounced up a little bit, but people are they're just not building or moving to houses as rapidly as I would have guessed they would have, based on figures prior to 2008 and 9, and considering the recovery we've had, and considering the fact that money is so cheap. And that has some effect on our furniture stores. I think we've got a very, very good furniture operation, not only at the Nebraska Furniture Mart, but at other furniture operations. And we will see whether the models work over the long run, but I think they have a reasonable chance. Some things we're learning that people will buy some things that they've always gone to the mall or to a retail outlet to buy, that they will do it online, and others don't work so well. Charlie?
I think that we'll do better than most furniture retailers.
I think that's a certainty.
Yeah.
Overall,
Yeah.
overall, we've got some good operations there, and but we don't want to become a showroom for the online operations and have people come and look around the place and then order someplace else. So we have to have the right prices, and we're good at that at the Furniture Mart. Station 4.
Warren and Charlie, my name is Brent Muyo. I'm from Winnipeg, Canada. First, thank you for devoting so much time and energy to education. I'm a better investor because of your efforts. But more importantly, I'm a better partner, friend, son, brother, and soon-to-be first-time father. There's nothing more important than these relationships, and my life is better because you're willing to pass on your experience and wisdom. My path into finance was unconventional. I worked as an engineer for 12 years, while 2 years ago I began a career in finance, working for the Civil Service Superannuation Board, a $7 billion public pension fund in Winnipeg. I work on alternative investments, which include infrastructure, private equity, and private credit. I go to work every day knowing that I'm there to benefit the hardworking, current, and future beneficiaries of the fund. Like most asset classes, alternative purchase multiples have increased. More of these assets are funded with borrowed money, and the terms and covenants on this debt are essentially non-existent. With this in mind, and knowing the constraints of illiquid, closed-end funds, please give me your thoughts on private alternative investments, their relevancy in public pension funds, and your view on long-term return expectations.
Yeah, if you had leveraged up investments in just common stocks, and you'd figured a way so that you would have staying power if there were any market dip. I mean, you'd obviously have obtained extraordinary returns. I pointed out in my investing lifetime, an index fund would do 11%. Well, imagine how you'd have done if you'd leveraged that up 50%, whatever the prevailing rates were over time. So a leveraged investment in a business is going to beat an unleveraged investment in a good business a good bit of the time. But as you point out, the covenants to protect debt holders have really deteriorated in the business. And of course, you've been in an up market for businesses, and you've got a period of low interest rates. So it's been a very good time for it. My personal opinion is if you take unleveraged returns against unleveraged common stocks, I do not think what is being purchased today and marketed today would work well. But if you can borrow money, if you can buy assets that will yield 7 or 8%, and you can borrow enough money at 4 or 5%, and you don't have any covenants to meet, you're going to have some bankruptcies, but you're going to also have better results in many cases. It's not something that interests us at all. We are not going to leverage up Berkshire. If we'd leveraged up Berkshire, we'd have made a whole lot more money, obviously, over the years. But both Charlie and I probably have seen some more high IQ people, really extraordinarily high IQ people, destroyed by leverage. We saw long-term capital management where we had people who could do in their sleep math that we couldn't do, or at least I couldn't do, working full-time at it during the day. And I mean, really, really smart people working with their own money and with years and years of experience of what they were doing. And it all turned to pumpkins and mice in 1998. And actually was a source of national concern, just a few hundred people. And then we saw some of those same people, after that happened to them once, go out and do the same thing again. So it's, I would not get excited about so-called alternative investments. You can get all kinds of different figures, but there's probably at least $1 trillion committed to buying, in effect, buying businesses. And if you figure they're going to leverage them, 2 for 1 on that, you may have $3 trillion of buying power trying to buy businesses in the U.S. market, maybe something over 30 trillion now, but there's all kinds of businesses that aren't for sale in that thing. So the supply-demand situation for buying businesses privately and leveraging them up has changed dramatically from what it was 10 or 20 years ago. And I'm sure it doesn't happen with your Winnipeg operation, but we have seen a number of proposals from private equity funds where the returns are really not calculated in a manner that, they're not calculated in a manner that I would regard as honest. And so it's not something. If I were running a pension fund, I would be very careful about what was being offered to me. If you have a choice in Wall Street between being a great analyst or being a great salesperson, the salesperson is the way to make it. If you can raise $10 billion in a fund and you get a 1.5% fee and you lock people up for 10 years, you and your children and your grandchildren will never have to do a thing if you are the dumbest investor in the world. But, Charlie?